Well, joining me now to talk more about the economy and thus the impact on stocks is Joe Brusuelas, Principal and Chief Economist at RSM. Joe, it's great to have you on the show.
Thank you very much, Kristen. Thanks for having me on again.
We're happy to have you as always. And let's talk about the state of play here because several things have changed since we last spoke. Earnings season, of course, winding down, as I noted earlier, and definitive results for what Washington will look like going forward.
Well, you know, those earnings you mentioned to open the show are really benefiting from a very strong tailwind in the economy that's driven by two things: an incredibly robust labor market and a consumer that's now seeing wage gains above inflation that's translating to really strong spending. You know, the president-elect is going to inherit an economy that's in an incredibly good place. And one of the reasons why you are seeing the response you are in U.S. Asset markets is there's an expectation now that the 2017 Tax Cuts and Jobs Act is going to be rolled over and extended. Moreover, there's likely to be further tax cuts. The fiscal expansionary policies that the Trump administration are going to pursue, at least in the near term, will juice both asset markets and likely provide an additional tailwind to an already strong economy into 2025.
What does that mean for growth in the next 12 months?
Okay, so we have a growth rate in our forecast right now. It's 2.5%. Now, it's well above the 1.8% long-run trend. And let me tell you, when you compare it to our major trading partners inside the G7, the U.S. is going to have another year of outperformance. Now, because of the additional light regulatory touch the Trump administration figures to have, we're going to get a lot of churn. There's going to be mergers, acquisitions, lots of fees and deals. So you're going to see a lot more risk appetite on the table. While our base case is 2.5%, we attach a 55% probability to that for next year. The alternative to the base is no longer a recession. It's the economy outperforms and grows above 3%. We attach a 25% probability to that. So my sense here is that we're going to be between a very good economy and one that's just firing on all cylinders and looks very robust in 2025.
Very good, I think, for our viewers to hear, Joe, especially heading into the holidays. And Gap noting that to some extent in its earnings report just yesterday. I want to talk to you about tariffs because, of course, that was one of incoming President Trump's campaign promises. How are we see companies, the economy starting to prepare for potential tariffs?
All right, well, there's three big things I think we want to remember here. Is first, you know, on Wednesday morning, right after the election, our clients started calling us to ask, what should we do? Because they were burned last time by thinking these were just negotiating tactics.
I see.
They're not. Trump is going to impose tariffs probably on January 21st on the Chinese and their supply chains. So we're telling firms to pull forward as much activity from 2025 into the current quarter and the first month of 2025. I think that's a very prudent move. Second, we're urging, and our clients are clearly thinking about diversification away from those supply chains back into the U.S.'s currency block, its trade zone here in North America, or the United States itself. Now, on the tariffs, we do not expect a 10% across the board or 20% across the board on day one on all goods. I just think that's not in the cards. What you're likely to get is somewhere between 20 and 60% tariffs placed on the already 25% that on select number of goods from China. That's really where the tensions and the conflict is going to be, we think, for the first half at least of 2025.
Interesting. So it would have some impact, even though it sounds like even accounting for the tariffs, you still have a very positive view on economic growth in the next 12 months.
The growth is so strong that it's going to offset the drag on firms that have to pay higher import taxes on goods they import from those Chinese supply chains. Now, remember, you increase import taxes, they're paid at entry. Those firms are going to pay them. Then they have to accept either thinner margins or attempt to pass as much along to downstream to customers as they can. The Chinese don't pay for them. Okay, that's really important that we state that at the outset. Now, because consumers are very price sensitive, only in our own internal data, only 50% of our clients indicate an ability to pass along those costs. So that is one of the risks going forward next year. And then lastly, you want to watch currencies. Currency volatility, specifically the Chinese yuan, if that depreciates, it offsets those costs. Then we get into some more dicey, dangerous territory.
Joe, very good to know. I also want to talk about what this means for the Fed's policy, a key story that we cover on a day-to-day basis, of course, here at the stock exchange across various different asset classes. This morning, I had seen that traders betting of a 59% chance of another 1/4 percentage point rate cut in December. Do you think the Fed delivers on that?
I think they do, but then they slow down in the first quarter of next year. You know, by the time they have their March meeting of next year, they're going to know where tariffs are at. They're going to know where fiscal expansionary policy is, and they're going to be able to make an assessment about the inflation risks. Now, right now, we don't expect much of a problem on inflation in the first half of next year. But if it does look like price levels moved up, inflation's picked up again, the Fed may have to reassess the number of cuts. We have 75 basis points of cuts on the table for next year, but we think 50% really is, or excuse me, 50 basis points is really a risk. Now the market has not quite priced that in yet.
Right.
So again, that's just something that we're going to want to watch closely, and that will impinge on asset prices in 2025.
Talk to me more about that, because for our viewers who do follow the stock market regularly, how could they see that show up in asset prices like stocks?
All right, so what you want to do is you want to look at two things, the Fed futures market and the overnight index swaps. That gives you a sense of where investors think Fed policy is going. If Fed policy gets less restrictive, then asset prices will tend to go up. If it's less restrictive than expected, then asset prices will flatten out or could conceivably drop, depending on the nature of the risk to the economy and the inflation outlook.
Joe Brusuelas, he's so good, he's going to join us again here just after the market opens. He's a principal and chief economist at RSM. Joe, thank you. We'll see you soon.
Thank you.
All right, we are off to the races for trade on this Friday here at the New York Stock Exchange, and rejoining me now is our expert on markets today and notably the economy, Joe Brusuelas. He's a principal and chief economist at RSM. Joe, welcome back.
Thank you.
We're officially open for trade, and I want to revisit actually some of the European data that we got overnight in terms of what it is saying about that particular market.
Well, it would appear that the European economy is being pulled back down into recession. You know, demand for services literally just dropped off the charts this morning. And so what that did was it caused a really big move in the euro, which fell below 104 this morning. You know, I think as we move forward here into the new year, we're going to test parity against the dollar. That's got to do with a lot of things, not just European weakness, tariffs, and the growth and interest rate differentials in the United States. But we not only just saw it there, you saw the spread between the benchmark, US and German 10-year yields really began to blow out. And now this is important out there. If you're a financial markets person, you're trading, these are the things that you want to know. A little inside baseball for everybody, but you have to be aware of it. The five-year forward inflation swap in Europe moved back to 2%, and again, it just fell off the cliff this morning. What that means is global investors are now pricing in real problems in Europe and problems over in Asia. So, you know, in many ways, what you're going to see next year, Kristen, is a continuation of capital inflows into the United States. Now, I got the killer statistic for you this morning.
What is it?
All right. Capital flows into the U.S.
Yes.
is greater than the sum of the next largest 12 economies.
Wow.
Yeah. And the U.S. is going to act like a magnet for global capital going forward on all of those things that I mentioned, plus the fact that we're going to get another round of fiscal expansionary policy out of Washington under the new Trump administration. So, you know, if you're out there and you're trading, liquidity is going to be plentiful next year. It's going to be looking for greater returns on investment. That's why we get UltraPar here at the exchange today, because they want to be a part of that to fund their own domestic and global exploration needs.
Thank you so much for making that connection, Joe. You're so good at that here in terms of how it matters for us, especially in the United States, all the pieces around the world. I am curious in terms of what we can expect to unfold in the U.S. economy, bringing it back home here. Of course, labor and labor costs is another factor that would be good for us to talk about as we talk about the jobs market and what it means for corporations going forward amid the changes that we'll see in January.
Okay, so the U.S. labor market really remains tight by historical standards. But we have a demographic issue. 11,000 people are retiring a day. We just don't have enough native-born population to fill the jobs. Over the last 4 years, we've imported labor. right? But we're going to now turn towards a much tighter immigration stance. And one of the things we're going to want to watch closely, that unemployment rate's at 4.1%. Should unemployment really get, or excuse me, should labor, net immigration really be choked off, we would then look for the unemployment rate to fall and wages to begin rising again. You know, we barely missed a wage price spiral during the post-pandemic price shock. Okay, because we're just going to have a different policy going forward, this is something that firms will want to watch. You know, if you're owning stock, what's the rule of thumb? 70% of cost are directly related to labor. You begin to get a shortage in labor, especially in areas like construction, agriculture, leisure and hospitality, just to name a few. You're going to want to watch those valuations going forward due to the policy shift in Washington, and that is going to be one of the bigger risks. Now, we don't think it's first half or really even third quarter of next year. It's the very end of next year and then 2026, where I think you and I may be having a very different discussion about the risk matrix around inflation in the economy and also to equity valuations.
We will certainly be turning to you then, Joe, as we always do, for your insights on the economy. I am curious to get your take from an economic perspective about the complete rip that we've seen in cryptocurrencies, specifically Bitcoin, as that crypto does approach $100,000 a token. What is the right way to look at it from an economic stance?
All right, so there is no economic rationale or value for Bitcoin. It's a highly speculative asset. We have assets like that all over the economy. And if you want to play in that market, if you're willing to take all your risk capital and lose it, then it's appropriate that you do so. Now, my sense is as we approach 100,000, this is beginning to look a lot like another speculative bubble, right? Where you're really taking some risk, and we're going to be in high volatility territory, which Bitcoin always is. You know, over the years, Bitcoin started out as a potential substitute for the dollar. Now, Bitcoin's now predicated as the benchmark or the base to which much of the different coins are priced or tethered. So we still have yet to understand what moves this and why, other than speculative activity, which it looks like it's linked to, again, possible policy changes in Washington at the turn of the year going forward. But you know, again, it's a highly speculative asset that's one corner of a highly liquid market, right? And to put it in perspective, if there's a $2 trillion liquid Bitcoin market, okay, that's fine, you want to respect that. But it pales in comparison to the $6 trillion a day churn in currency markets, and of course the over $30 trillion a day churn in the bond market, not to mention what goes on in equity markets. So we always want to put that in perspective, I think, out there, that it's a highly risky corner of the investment industry.
Always good to get your perspective, Joe. We so appreciate it. That's Joe Brusuelas. He's a principal and chief economist at RSM.